The most important thing in value investing is, well, not value. Hi guys, Stanley here. Today we're discussing the most important factor in value investing. Value investing has to be one of the most misunderstood concepts in investing. When we talk about value investing, the general assumption is that we are talking about investing in stocks that are cheap, and that is opposed to growth investing, where we're investing in fast-growing companies. However, that is quite wrong. Even Warren Buffett once commented in his annual letters that the two approaches are joined at the hip. Growth is always a component in the calculation of value. That means that there is no value in a company if there is no growth. And growth is actually the most important factor in value investing. If we invest in a stock that is just cheap but show no growth at all, we are investing in what we call a value trap. And that is something that we must avoid at all costs. This is because a value stock that is not growing at all would see its value decline over time. Because of inflation in the market, the value of our money is constantly shrinking. And even if the profit of a company stays the same, the real value of that profit is shrinking due to inflation. This means that a company would need to at least grow in line with inflation just to maintain its value. Value traps come in many forms, but the most common ones are companies that are facing some disruption to their business. Actually, the most iconic value trap is actually Berkshire Hathaway itself, the company of Warren Buffett. I am of course not talking about the current Berkshire Hathaway, but rather the Berkshire in 1960s when Buffett first took over the company. At that time, the textile business was being disrupted by overseas manufacturers, and that business would have really destroyed the whole company as it turns very unprofitable and was closed down after a few decades. Berkshire would have really become a value trap if Buffett had not saved the company by reinvesting their profit into more profitable business like insurance and grow the business beyond its textile roots. Since the 1960s, Berkshire Hathaway has actually returned more than 2.7 million% till today. Yet, the key reason why Berkshire turned out to be a great stock to own is not because it is a cheap stock, but rather it is because it has been able to grow consistently through the decades. Thus, this means that without growth, a company would not be such a great investment. Today, there are many cheap stocks in the stock market as well. Companies that are cheap and appear to be good value stocks. Some of these cheap companies include well-known companies like Star Media Group Berhad or Singapore Press Holdings. But these companies are unable to grow its business over the past decade. Both companies are the main newspaper press of Malaysia and Singapore respectively. Both companies are also trading at very low valuation but have continued to stay cheap. This is because both companies are facing disruption to their own business and have yet to show that they are able to reverse that trend. In Star Media Group case, the company is actually trading below its cash value. However, minority investors would not be able to access that cash if management refused to pay them out to investors. So investors only have two positive outcomes. Either management pay out excess cash, which will give investors a one-off gain, or management is able to turn around the business, and investors will be holding on to a new growth company. Other than that, investors will really be faced with a value trap. So when investing, a better option for investors is really to avoid investing into a value trap in the first place. And one way we can avoid falling into a value trap is look for companies that are actually growing. If we only go for stocks that are cheap, there is a higher chance that we will fall into a value trap. I always say, after all, buying cheap rubbish is still rubbish. If you want to learn more about investing, you can also check out our free online course where we'll go through the basics of investing with you. Remember to click on the link in our show note to get started. That's it from me. My name is Stanley. Till we meet again, invest safely.